Quant Fund House has always been a hot topic of discussion, be it its investment strategy, the returns generated by their funds, or its investment in Adani Group stocks. So, in today's video, we'll do a detailed review about one more popular multi-cap fund from Quant Fund House, that is Quant Active Fund, and see whether this fund is really worth investing and will it be able to generate good returns in future also. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. So let's start the video with the basic details of this fund. First, the AUM, that is total asset under management, which is around 3,700 crores, which I feel is okay for a multi-cap fund. While the expense ratio is 0.58%, which again is not on a higher side as compared to other schemes in the category. The benchmark index, that is the reference against which the scheme is compared, is Nifty 500 Multicap 50 25 25 TRI. Now let's look at the sector-wise allocation. From the graph, it is very clear that the fund is heavily invested in financial sector, followed by consumer staples, healthcare, chemicals, construction, energy, and services. Generally, financial sector is considered as core sector, whereas consumer staples and services are considered as evergreen sectors. Here, the fund manager has the option of picking stocks from all the categories. When the sector allocation is compared to its benchmark, the allocation is quite different. Here, one thing should also be noted that allocation to the financial sector is quite high, and such high allocation to a particular sector can lead to concentration risk and can dampen the performance of the fund if the sector does not perform well. So now let's look at the top holdings and portfolio allocation. As evident, HDFC Bank, State Bank of India, and Punjab National Bank are the main stocks of the financial sector, whereas Reliance Industries is the main stock of the energy sector, whereas ITC is from the consumer staples, whereas IRB Infra and L&T are the main stocks of the construction sector. Here, one thing should be noted that the fund has a tendency of changing stocks in the portfolio very fast, and hence it has a turnover ratio of more than 100%. The portfolio is quite concentrated as there are only 55 stocks and the top 10 stocks for around 47% of the portfolio, whereas top 3 sectors contribute to around 42% of the portfolio, with around 24% coming only from the financial sector. Here, the portfolio PE and PB are okay and suggest a blend of growth and value stocks. Now let's also check the portfolio allocation. Here if you observe, large cap stocks form around 54% of the portfolio, whereas mid cap stocks form other 27% of the portfolio, and the rest 19% is allocated to small cap stocks. Here, the fund manager has to allocate minimum 25% to each category, that is 25% of large cap, mid cap, and small cap stocks, and rest 25% can be allocated to any category of his choice. Right now, the fund manager has allocated this 25% to large cap stocks, which can make the portfolio less volatile. Let's see this in the later part of the video whether this strategy works or not. Now let's look at the fund managers. Mr. Sanjeev Sharma has been managing this fund since October 2019, that is almost from the inception of the scheme. Here, one thing should be noted that in mid-2018, Escorts Fund House was acquired by Quant and all the schemes were renamed as Quant schemes. Mr. Sanjeev Sharma has been joined by Mr. Ankit Pandey in May 2020 and by Mr. Vasav Saigal in April 2022. All these three fund managers have been managing not only this scheme but also other schemes like Quant Flexi Cap Fund, Quant Mid Cap Fund, Quant Small Cap Funds, and others. Now let's compare the returns. First, the trailing returns. Here, we should compare the trailing returns for period 5 years and less only, as Quant had acquired Escorts Fund House in mid-2018, and after that, all the were renamed as Quant schemes, and the investment strategy and the fund managers were also changed. Here, for 5 years and 3-year period, the fund's performance is quite good as compared to its benchmark index, but for period 1 year and 6 months, its performance has been poor. The reason for this underperformance is due funds exposure in Adani Group stocks and the crash in Adani stocks after the Hindenburg report has led to this underperformance. Here again, the fund's performance for last 3 months and 1 month, it is better than its benchmark index. The category of multi-cap funds is a new category and was introduced in January 2021 only. Hence, comparison data of trailing returns for this category is not available for period 1 year and more. Let's also check the trailing returns for the year 2023. As evident in the graph, the fund's performance has been quite poor, especially after 23rd of January 2023, and the main reason for this is its exposure of Adani stocks. And as per the report, it has been selling its Adani stocks after the Hindenburg report, which was published in late January 2023. By now, it has sold all its holding, and hence, now we can see a better performance in the coming times. Now, let's also check the calendar returns and see how the fund is consistent in its performance. Leaving aside the year of 2019, when the fund has underperformed, the fund's performance in all other years have been better than its benchmark index and category. Especially after 2020, it has usually outperformed its category and benchmark. Hence, we can safely conclude that the fund is quite consistent in its performance. Now let's also quickly check the rolling returns. Here, we have rolling returns for the period 1 year, 3 years, and 5 years. For 1 year period, the fund is able to beat its benchmark 82% of times. Whereas for 3 years period, it is able to beat its benchmark 95% of times. And for 5 years period, it is 100% of times with zero negative returns. Surely, this performance can be considered quite good. Hence, it can be concluded that for a longer investment horizon, the fund's performance is quite good and chance of negative returns is not there if the investment horizon is of 5 years and more. Now let's see how the fund performs on risk parameters. Here, we compare the parameters with the benchmark index and the category average. First, the mean return, that is, the average return in a year, which is 37.07, which is quite high than both the category and the benchmark. Here, higher the value is better. Second one, standard deviation. That is a tool to measure how much the returns is deviated away from the mean returns, which in this case is 18.07, which is more than the category average and the benchmark index. Here, lower the value is better. Third one, Sharpe ratio. That is a tool to measure the risk-adjusted returns, which is 1.83, which is more than both the benchmark index and the category average. Here, higher the value is better. Fourth one, beta. That is the volatility of the scheme compared to the benchmark, which is 0.95, which is less than the category average. Here, lower the value is better. Fifth one, alpha. That is a tool that measures how much better the fund has performed compared to the category. Here, it is 14.08, which is quite high than the category average. Here, higher the value is better. Here, on almost all risk parameters except for the standard deviation, that is the volatility, Quant active fund performs better than the benchmark index and the category average, which is quite a positive sign for a fund. Now let's see the upside and downside capture ratios. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here, the value is 126, which indicates that the fund outperformed 26% more than the index during this rise period. Here, higher the value is better and should generally be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index has dropped. Here, the value is 67, which indicates that the fund declined 67% as compared to the index during the fall period. Here, lower the value is better. The upside ratio and the downside ratio both are quite good, and it has been generally been observed over long run that fund having a higher downside protection ratio are able to generate better returns. Here, as both the ratios are quite good, the fund has a potential to generate excellent performance in long run. Now let's see the risk return graph. Here, on x-axis we have standard deviation, whereas on y-axis we have total returns. It is very evident from the graph that the fund has better total returns value with a higher standard deviation as compared to the benchmark index and the category, which indicates that the fund is able to generate better returns than both the category and the index, but with a more volatility as compared to its benchmark and the category. Generally, higher volatility is directly linked to higher risk, but if the investment horizon is longer, then this does not always stand true. So now coming to the conclusion, what should investors do? But before concluding this video and suggest what investors should do, I would request all of you that as you have watched the video till now, it seems that the topic is of your interest. Hence, I would request all of you to press the like button and also subscribe to my channel if you have not done till now to watch such interesting videos in future also. So now let's see what investors should do. First, the existing investors. As the fund's performance is good and is able to generate good returns, I feel there is no need for the existing investors to worry and continue their investment in this fund. The volatility of the fund should not be a concern if the investment horizon is long, say typically 5 years and more. I personally feel that this category of funds are more suitable for persons who are quite new to mutual funds, who have a small SIP amount and want to have only one SIP, then this category of funds are ideal. Second, the new investors. For a new person who is starting investment in mutual funds and has a small SIP amount, can start his SIP in this fund. But when the investment amount increases and plan to go with more SIPs, he can go with traditional funds like large cap, mid caps, and small caps, and have its own allocation in the respective categories. This is my personal opinion. You may have a different opinion. What do you think? Do you have investment in multicap funds? Do share your views and comments in the comment box. I would like to add that presently I do not have Quant active fund in my portfolio and not planning to start investment in this fund, as I have my own investment in other large, mid, and small cap funds. I will again try to review this fund after 6 to 7 months and check its performance. So stay tuned to my channel. Please subscribe to my channel if you have not done till now, and also press the like button. Do check my older videos. Click the attached cards to watch the videos. Thank you.